Ladies and gentlemen, a very warm welcome to you on Business Today Television. At this stage of the market, when another rate cut has happened, a lot of strong tailwinds are there in the system already, and the Nifty has marked a record high as far as the early part of December is concerned. Where are mid-cap and small-cap PMS fund managers at this point of time? How are they managing their portfolios, and how do they see the gains in the coming year as well? We are now joined by Mr. Aditya Khemka, Chief Investment Officer at InCred Asset Management. Mr. Khemka is a very, very well-known stock picker in the world of pharma, in the world of diagnostics, and of course in the world of the broader stock picking. He runs 3 mid-cap, small-cap portfolios which are index agnostic, bottom-up approaches, and have delivered supernormal returns in the market. Let's discuss each of them in detail with Mr. Khemka. Namaste Aditya ji, as always it's a pleasure to host you. At this stage, when we are at the fag end of 2025, with the benefit of hindsight, how do you see 2025 panning out, and what are the expectations that you have from 2026, given rate cuts, given strong tailwinds, and given a higher GDP than expected?
Thank you, Shelji, for having me, and good afternoon to you as well. So, Shelji, what I see coming forward so if I look at FY25, I think it was a year of disappointment as far as index stocks are concerned. So if you look at Nifty 50, BSE 500, and if you look at the earning growth that these companies have reported, so first half Nifty 50 earning growth is around 6% if you exclude OMCs and metal or commodity companies. So 6% earning growth is not exactly what we were hoping for. I think at the beginning of the year, the EPS estimates for Nifty 50 were closer to 10-12% growth, and they have come in at first half come in at 6%. So clearly there is an underperformance versus our expectations. And obviously with that, as the market has refused to sort of correct, we believe that the market is getting a little more expensive with each passing day as earnings continue to disappoint, but the market doesn't correct. So the PEG multiple and the PE multiple keeps going up. So for FY26, again, if you look at the current estimates, most analysts are expecting anywhere around 12 to 15% bottom line growth for Nifty 50. And I think, that's again a steep ask given where we are today. And that is again excluding OMCs and commodities. So excluding OMCs and commodities, in my view, to do 12 to 15% growth for Nifty 50 in FY26 will be a steep ask. There is no denying that the GST cut, the income tax rationalization for up to 12 lakh income, and the global tailwinds are positives for us. But I see enough headwinds also in terms of, consumption trends wavering. I see people trying to save more, deleveraging their balance sheets rather than leveraging further. And these things are sort of going against the consumption. So what we have to realize, Shelji, is that almost 60 to 70% of Nifty 50 index weights are in stocks which are end of the day driven by consumption. And if consumption doesn't pick up, then 60-70% of Nifty 50 as an index doesn't perform. And I don't see consumption picking up sustainably. It has picked up in 2Q. It will show a minor uptick in Q3 as well. This is largely the GST impact. But I think 4Q will be a telling quarter. And my expectation as of today is that 4Q will show relatively flat earning growth, a single-digit earning growth for Nifty 50. And that is where, again, I think the market will get a little disappointed, and we might see more earning cuts for FY27 then after 4Q.
Okay, that's a slightly, how should I say, overtly cautious assumption of where the markets are headed, be that as it may. But your portfolios have given substantial returns even when they are in the mid-cap and small-cap space. Needless to say, most of them have outperformed not only their benchmark index, but the wider PMS universe as such. And I would imagine that it's prior preparation that's prevented poor performance. Some of it is luck as well, given the way the markets have appreciated pharmaceutical, diagnostic, hospital stocks. So what now? How do you see this defensive portfolio with pharma, diagnostics, hospitals, a bit of telecom, a bit of the internet space via Yatra and Tejas performing over 2026? Do you continue these high conviction ideas?
Yes, Shailji. So for all our portfolios, be it the small and mid cap, multi cap, or healthcare, we foresee a 20% earning compounding for all three portfolio companies. And this is 20% on a portfolio weighted average basis. So what we do as an exercise, Shailji, is we take all the companies in our portfolio, we take their PAT and we multiply the PAT with the weightages that these companies have in the portfolio to arrive at the portfolio's weighted average PAT. And as of today, our assumptions tell us that for the next 3 years, which is FY26 to FY28, we will see our portfolio companies compounding their PAT, profit after tax, at around 20%. Now, if you now think about what I told you in Nifty 50, so Nifty 50 PE multiple around 21 and earning growth, let's say around 7-8%. So you're looking at a PEG ratio of around 3. For our portfolios, the PE for small and mid cap and multi cap, the PE is close to 40 and the earning growth is 20. So we have a 2 times PEG. So compared to Nifty 50 PEG of 2.3, 2.4, our portfolio PEGs are around 2. And I think that has been our strength. I mean, if you ask me what has been our secret recipe to deliver superior returns to the benchmark, the recipe basically has been to identify growth opportunities which were available at reasonable valuations. And I think that is where we see our portfolio positioned at.
Mr. Khemka, I just wanted to ask a fundamental question in setting up these three portfolios. You are a very well-known analyst on the pharma side, and there is a massive overlap between all these three portfolios in terms of common stocks. There's new land across three portfolios. Indraprastha Medical is there, and percentages might vary, but commonalities stand out. Now, were these portfolios, when they were constructed, made with the assumption that my superior strength is pharma, diagnostics, hospitals, therefore I will work into this? Or did you find this sector to be a potential outperformer across the broader market?
No, it's the latter. So we actually found the portfolio to the healthcare space as a space. When we built these portfolios back in 2021, 2022, we were pretty confident that consumption growth, which was happening on the low base of COVID, was a temporary phenomenon. And once that low base translated to a high base because of the high growth, consumption would slow down. And the consumption would slow down, then we wanted to be in a pocket where consumption would be relatively non-discretionary. And healthcare comes out as one glaring pocket where consumption is non-discretionary. So our overweight in healthcare, both in the small and mid cap and multi cap, is a function of our view of the market that consumption is not going to pick up. It's not going to pick up as meaningfully as it is being priced in given the valuations of Nifty 50. So tomorrow if Nifty 50 were to fall, let's say to a 14-15 PE multiple, and let's say the growth outlook remains at 6-7% or 8%, then you're looking at a peg of 2 for Nifty as well. Then at that point in time, we'll be happy to sell healthcare stocks from these portfolios and buy some of the cyclical names or discretionary names like autos, like banks, like lending businesses. So we'll be happy to do that. But because that is yet not the case, the portfolio is still positioned as overweight on healthcare because we want to de-risk ourselves and differentiate ourselves from the other portfolios which are available on the street, which are anyways going to be overweight on consumption.
Fair point. I understand what you are trying to say, and it has given superior and consistent return. Say you can have a superior return one quarter and then be disappointed, but a superior return which is consistent over 7, 8, 10, 20 quarters, that is something that needs to be appreciated as a foresight that you had and as luck that many of your shareholders would have realized their luck as of now. Let's also look at the liquidity position at this point of time. What is the cash component across three portfolios?
So I think across different portfolios, we are between 5 to 9% cash levels. So such cash levels we generally keep. Uh, as we have noticed in the past 4 to 5 years, shares for some reason, December, January tend to be pretty weak months for the small and mid cap space. And us being dominant in that space, whenever we approach November, December, we try to build a little bit of cash cushion in the portfolio so that we can use the dip to buy the same stocks probably at a better valuation, and hence we generally maintain this 5 to 9% cash once we come close to the December month. And as we approach February, March, that is when stock prices get sort of bottomed out and they start to rally from there. We reduce the cash levels to 1 to 3% depending on each portfolio.
Fair point. So this is situational and seasonal. Fair
Yes.
point. Let's discuss two important holdings in your portfolio. One is HCG. This is Healthcare Global Enterprises. It has a 16% weightage in the healthcare portfolio and is present in the other portfolios as well. One, I wanted to understand what makes this as a super conviction idea in a high conviction portfolio.
Sure. So
That too
Shailji,
concentrated in one particular sector.
that is true. So HCG Shailji is a oncology super specialty hospital. So they do only cancer patients. Just to explain the business model to you. Now let's say we compare HCG to a multi-specialty hospital. That can be any multi-specialty hospital. It can be a Apollo, a Max, a Fortis, or whatever, a Narayana. So when you are comparing HCG to, let's say, a multi-specialty hospital, what happens in a multi-specialty hospital? You do gastro, you do maternity, you do ortho, you do cardiac, you do all kinds of disciplines, right? So what happens therefore is that a multi-specialty hospital in the first day of the financial year starts with 0 patient, and he has to acquire his patients throughout the year, because these patients are not repeat patients. A maternity patient can come to you, deliver the baby, and then not come to you for the rest of his life. Same for a gastro patient. He has an ulcer, he comes to you, stays for 3 4 days, get the surgery done, and then moves out of the hospital, and then never may come back to your hospital. So the multi-specialty hospitals every year begin their patient acquisition process from 0. And every year then they have to grow their patient base to 100, 120, 130 to show growth over their last year revenue, right? In a HCG, because it's only oncology, in oncology, a cancer patient is a patient for life. So when you're a patient for life, then let's say HCG has 100 patients last year. Let's say 10 of those patients pass away because cancer being cancer. And let's say 10 patients drop out because they're either cured or they don't like HCG, they want to go to somewhere else. Next year, HCG will begin with 80 patients. And then he has to acquire only 20, 30 more patients next year to grow over the base of the last year. So that is the difference between HCG's model. So this is called a chronic business.
Yes.
HCG's business is a chronic business, and the multi-specialty businesses are largely acute businesses. They are 60-70% acute, only 30% chronic. So HCG therefore every year begins at a higher base, and he has to add a very few patients to grow over the last year base. And multi-specialty hospitals start with a very lower base, and they have to acquire a lot more patients to grow at the previous year's base. So that is one reason why we believe HCG is a superior business model. Second reason is the fact that cancer is one of the fastest growing diseases in India. So if you're present in one of the fastest growing diseases in India, then obviously your patient pool is increasing faster, and so will be your revenue. Third reason is if you look at the valuation. So we are always, Shailji, you will hear me talk about business model, but we always talk about it in conjunction with the valuation.
Yeah.
Without the valuation, just the business model doesn't make sense to us. So in terms of valuation, if you look at SCG's valuation today, 10,000 crores market, 320 odd crores of cash flow last year. So last year when I say FY25, fiscal 25. So the stock is available to you at around 30 times trailing cash flow, right? The same number if you look at for other hospitals, especially the larger multi-specialty, they are available between 50 to 80 times cash flow, right? So the larger multi-specialty hospitals who will anyway struggle to grow on a larger base, plus they are more acute. This is a smaller super specialty hospital, will grow on a smaller base, plus he has more chronic, and he's available at a lower valuation, they are available at a higher valuation. So it just becomes a no-brainer bet from that perspective. Add to that the fact that SCG is controlled by a private equity. A private equity promoter basically ensures that the incentive of the minority and the promoter is aligned. Both want stock prices to go up, right? They have no other agenda. Whereas some of the other multi-specialty hospitals drop off, they are controlled by families. So the family promoters might have other agendas other than the stock price also. Sometimes do necessarily what is best for the stock price, right? So all these things basically make SCG a standout pick for us compared to other hospitals available.
So where do you see it hitting the overvaluation zone? At the moment, HCG has made a phenomenal amount of money for you. I'll request the PCI to kindly show the weekly chart. And over the last 5 years, ladies and gentlemen, HCG has appreciated each year by 37%. That's more than twice the healthcare index, and it is 75% more than what the BSC small cap index, which itself is a monster of a making, has appreciated. At what level would HCG be out of your valuation metric? What will you track?
So globally, Shailji, multi-specialty hospitals trade at a discount to super specialty. Or the other way to say it is super specialty hospitals trade at a premium to multi-specialty. Now in India today, multi-specialty hospitals are between 50 to 80 times trailing cash flow. SCG is 30 times trailing cash flow. So my guess is that when SCG breaches that 80 times cash flow multiple, that is where for us it becomes a sell. That is where it comes to a zone where we will start thinking that it's perhaps too expensive to own.
Fair point. So it's a cash flow to market cap is a key metric that you would look out for. Fair point. Is Indraprastha Medical also in the same boat as HCG? Of course, this is a multi-speciality hospital, and while at a record high or close to record high, its long-term returns are nothing to speak about in terms of what you've experienced with HCG or even other hospital stocks.
So if you see, Indraprastha Apollo is a more recent addition for us compared to HCG. Now the reason why we recently added this company to us is because Indraprastha Apollo, despite being a multi-specialty, it is a JV, joint venture, between Apollo Hospitals and the Delhi state government. Now the reason why this stock has not done much, let's say, over the past decade is because the hospital is a single unit hospital and it's fully utilized. And it is about 750 beds that they have in that hospital. And it is fully utilized. Like the occupancy levels are close to 80%, which tends to be the peak occupancy for any given hospital unit. Now, the reason why the stock did not do much over the past 10 years is because it has been at peak utilization for almost a decade now. And the promoters, which is in this case Apollo and state government of Delhi, did not expand the hospital. Now, the reason why the expansion was not happening, our opinion is that the Delhi government was inactive. They did not give approval to the entity to expand beds, although there was enough demand because the hospital was running at peak utilization. So they were not allowed to expand. Now, because they were not allowed to expand, the revenues did not grow in line with the market, and the stock did not do much. Now, what has changed here is that the Delhi government has now suddenly become active, and they have already granted approval to Indraprastha Apollo to expand their bed capacity. Our understanding again is that in the next 4 to 5 years, Indraprastha Apollo might increase their bed count from current 750 to almost 2,000 beds. And that will drive revenue growth, that because capacity utilization is not an issue for them at all. They have been at 80% capacity utilization for a very long time. So they will continue to attract patients because the quality of care is good, the catchment area is perfect, and the pricing is decent. So hence, they will continue to attract more patients. They just need more capacity. Now that capacity will come online over the next 3 to 5 years, and it's going to be all brownfield capacity. So as you know, brownfield capacities tend to break even faster compared to greenfield capacities. And because Indraprastha Apollo will be mostly brownfield, we expect the occupancy rates to pick up very quickly for the brownfield expansion, and that would result in earning growth, top line growth, and hopefully a re-rating in the stock as well.
Okay, brownfield expansion, ladies and gentlemen, is easier done than greenfield. Greenfield means you have to buy the plot of land also, where you will either construct a hospital or a factory. In the case of Indraprastha, it's blessed with a lot of land, which it got from the government of Delhi in exchange for a 26% stake. I'm talking about decades ago. Mr. Khemka, do you see the possibility of Delhi government selling its stake to a bidder in Indraprastha Medical?
It is a possibility. Ideally, the government has no business being an equity shareholder in a hospital unit. That's a very unique situation to Indraprastha Apollo. Not many other hospitals have government entities holding a stake in those entities. So I think it is a possibility that they may want to sell. And my sense is that if ever they are ready to sell, the first bidder is going to be Apollo Hospital itself. The reason why I say that is because Apollo Hospital, other than Indraprastha Apollo, doesn't have any significant presence in North India, and that's a market where I would feel that Apollo Hospital would want some footprint, and Indraprastha Apollo can be obviously the most organic choice given that they already have a stake in the business. So yeah, I mean it is not outside the realm of possibility that they will sell. When they sell, at what price they sell, obviously those things are very fluid and we can't really guess that at this point.
Fair point. Just the same revenue, cash flow to market capitalization model, where is Indraprastha placed versus HCG? You are willing to pay 30 times for HCG. What's the situation in Indraprastha?
I think Indraprastha is close to 25 times. But look, Indraprastha is a standalone unit and SCG is a chain. So there is a difference in that. And similarly, Indraprastha is multi-specialty and SCG is a super specialty. Yes. So there's no doubt that we like SCG more than Indraprastha, but that is reflected in the weights that we have taken in the stock. So that's how we manage our portfolios. Our conviction in the company is also reflected in the weight that we take in the stock.
Okay. Because Indraprastha, ladies and gentlemen, has a higher listed history, the stock has appreciated 22% CAGR over the last decade. In the last 5 years, each year, Indraprastha Medical has given a return of 55%. So that's stock picking and that's consistency, something that is Mr. Khemka's hallmark. Unfortunately, Aditya ji, as always, time just disappears when I speak to you. पता नहीं चलता कब आधा घंटा हो गया. लेकिन one final word on diagnostics. What is the space at this point of time, according to you? This is also a huge conviction bet with you.
Yes. So diagnostics we really like, Shailji. The reason why we like diagnostics so much is because it is the first order beneficiary of any growing healthcare ecosystem. Now India, is at a point where if our GDP per capita grows, a substantial part of the incremental GDP per capita that India earns will be spent on healthcare, because roti, kapda and makan, we are almost through. When you touch $2,500 per capita GDP, roti, kapda and makan basically begins to stagnate as a percentage of your GDP. And the incremental GDP actually gets allocated more to other services as well as healthcare. So if India is at that juncture where healthcare market in India is going to compound much faster than the GDP of India, then we would like to be overweight on the first order beneficiary of any of the Indian healthcare ecosystem, and that is always diagnostics. What do I mean by first order beneficiary? That is because if any person wants to get treated, first he needs to know what is wrong with him, and that is where diagnostics come in. So there will be 3 types of patients. One who get diagnosis and the doctor says there's nothing wrong with you, sleep it off, take rest, and you'll get better. Second, patient gets diagnostics, doctor says there's something wrong with you, take the medicine for 3 days, don't go to office, you'll get better. Third type of patient, get diagnostics, take the medicine for 3 days, if you still don't do well, get admitted to a hospital. So in terms of the order, the first order beneficiary of any growing healthcare ecosystem is diagnostics, second order beneficiary is local pharma, third order beneficiary is the hospital. Right? So we always want to be part of the first order beneficiary, which is where diagnostic come in. Add to that the diagnostic market in India is 80% unorganized, only 20% organized. And the market itself is growing at 10%. So the organized players are growing faster. So if you are able to identify companies which are growing between 12 to 20% top line, imagine what kind of bottom line growth these companies are reporting. And the stocks are not expensive. These stocks are available at 35, 40 times operating cash flow, compared to, let's say, food and beverage and clothing stocks available at 100 times cash flow.
Yeah.
And those markets are going to grow slower than diagnostic market. So it's
I don't know the right saying in Tamil, but there is that very interesting thought. How do you make a line shorter without rubbing it or without cutting it? The best thing is to draw a longer line next to it. So this is what you do when you want to compare an expensive stock. You compare it with an even more expensive sector to justify 35, 40 versus 100. Nevertheless, because it's paid off to you handsomely, let's accept it. My final question to you is the defense of Tejas Networks. This is a stock that has halved, yet it remains in your portfolio.
Yes. So Tejas for us, Shailji, is an innovator company. It's an innovation company. They're coming up with new solutions which don't exist today in the marketplace. And if you look at the evolution of any innovation company, go back in history and check the evolution of Amazon, Google, the AI companies today, right? They, at the beginning of their juncture, they are always very, very concentrated in a couple of solutions, in a couple of customers. And when you are concentrated in a couple of solutions or a couple of customers, lumpiness in earnings is a feature of your business model. Because some of these customers will give you orders for a year, 6 months, 2 months, and you will execute the order, and then they will take the product or solution, and then they will test the product or solution. Now the test might last for 6 months, 1 year, 2 years, depending on the satisfaction of the consumer. Once he is satisfied with it, then you get a repeat order. And that is when again your revenue bumps up. And then if this customer gives you a repeat order, another potential customer sees that this customer is giving you a repeat order, then the next customer comes to you to give his first order. Then he takes his own sweet time of 2 years, 3 years to evaluate a solution, and then again he gives you a repeat order. And so on, the business sort of builds out, right? So the evolution of any innovator business, be it in pharma, be it in telecom, be it in IT, it has been that at the beginning earnings become very, very lumpy and the stock is highly volatile, very, very volatile. And then as the business establishes itself, as the solution is recognized as a great solution or an innovative solution, then the business becomes much more secular and it grows in one line, linear growth, right? And that is what we see as future of Tejas Networks. So what you are seeing in terms of the stock today is the stock reacting to the fact that they currently don't have an order in hand. What you do not see the stocks showcasing is that why did they in the first place get the order from BSNL? And they were able to execute it in 1 year, and they were able to execute a very large order, and BSNL seems to be happy with the order because BSNL has already announced its capacity expansion on 5G, 6G, and the natural partner for them is going to be Tejas. So to us, it's just a matter of time before they get the next order from BSNL, and the moment they get the next order from BSNL, we are looking at Airtel, Jio, Vodafone thinking as to why BSNL is placing order with Tejas and should we be doing business with them? And that's when you get your second customer, right? And so on and so forth. So we are not at all worried about this drawdown in the stock. It's a playbook of innovation companies.
Okay. Have you reduced your stake in Tejas? Have you added to it post the correction?
No, we have added weight in different portfolios. We have not sold Tejas at all post the correction.
Okay. On that very optimistic note, Aditya ji, as always, it's a pleasure to host you and listen to your very deep and thoughtful investments in the pharma space, the diagnostic space, and the hospital space. Thank you for your time, and here's wishing you all the best for 2026.
Thank you, Shailji, and same to you.
That, ladies and gentlemen, was Mr. Aditya Khemka, Chief Investment Officer at InCred Asset Management, a company that has given supernormal returns in the mid-caps and the small-caps segment based on their 3 very concentrated portfolios in the healthcare space. I hope you enjoyed the interview as much as I did by conducting it. I'll be back at 3 p.m.
The court said yes. The authorities said no. And the crowd said enough.